Most traders rely on one chart to make a decision, but the real edge comes when you verify patterns across related markets. Well, that's how you shift from guessing to forecasting, supercharging your analysis and your trading. I'm Peter Goodburn, and I've spent over 4 decades applying Elliott wave analysis to financial markets, not just in theory, but in real-world forecasting and trading. And if there's one truth I've learned across all asset classes, it's this: there are no certainties in trading, but there are ways to increase the probability of being right. Well, that difference between chasing unrealistic uncertainty versus embracing heightened probability is the key psychological shift that separates struggling traders from strategic ones. Well, let me show you what I mean. You've probably seen the movie Back to the Future 2. Marty and Doc Brown travel to the year 2015. But while they're there, Biff Tannen, the film's antagonist, steals the DeLorean, goes back to 1955, and gives his younger self a sports almanac with all the future results. Well, armed with that perfect knowledge, young Biff becomes rich by betting on certainty, changing the timeline entirely. Now imagine that in trading, knowing every outcome in advance. Sounds tempting. But that kind of certainty doesn't exist in real markets, and chasing it leads to danger. History shows us this, from Bunker Hunt's failed silver corner to Hamanaka's copper fiasco in the 90s. They weren't lacking information, they were trying to outmuscle probability. What we actually need as traders is not fantasy level foresight, but a method to increase forecasting probability with discipline and structure. And that's where cross-market comparative analysis comes in. Here's how that looks in action. In July 2024, the S&P 500 and the Nasdaq 100, they both completed 5-wave impulse advances from the October 22 lows into the July 2024 highs. Now, a correction was expected. And sure enough, a corrective downswing unfolded into an August 2024 low. But when we zoomed in and did cross-correlation index analysis, also comparative analysis with equities, something important jumped out. The indices corrected as a 3-wave zigzag, whilst Microsoft, one of the major components of the indices, it declined as a 5-wave impulse pattern. Well, that might seem conflicting signals. 3 waves down in one, 5 waves down in another. Not at all. If you know how to compare patterns across these instruments, what we saw wasn't contradiction, it was coordination with different pattern structures. Now, these indices were set to continue unfolding as a more complex 3-3-5 expanding flat pattern, whilst Microsoft was set to continue developing as a 5-3-5 zigzag. Different corrective patterns, different performance, different application of Fibonacci price ratios, but same rhythm, down, up, down. Well, this gave us a high probability confirmation that the indices upward breakout in wave B would outperform, but would be short-lived, followed by a very sharp decline. And that's exactly what played out in the S&P 500 and the Nasdaq 100 indices, where wave B traded up from the August lows in those indices, breaking above the July highs, and you can see this in our update from the Elliott Wave Compass report dated December 15th, 2024. And the resulting price decline in wave C into the April 25 low. And the Nasdaq 100's break above July's high also as wave B of the expanding flat pattern last December, January, with the following decline as wave C into the 2025 April low again. Well, now let's look at how Microsoft unfolded. It began July's decline from 468.35 to August's low of 385.58, and that unfolded into 5 waves, not 3 in this case. And it confirmed the developing zigzag pattern rather than the expanding flat pattern which was synchronously developing in the indices. Well, this meant that wave B cannot break into higher highs unlike those indices as part of that zigzag. And it would then signal that wave C declines would develop, to fib price ratio targets of 342. Well, fast forward to April 2025 and the low was 344.79, less than $3 deviation from our forecasts. And that's accuracy through comparative analysis. No trading almanac, but through cross-correlation checking, we had something almost as good, a robust probability framework. Well, from doubt to clarity, this is the shift in application I've seen in traders who move from frustration to mastery. When you only look at one chart, you're really in the dark. But when you compare cross-correlated markets, you start seeing the system beneath the surface. Well, that changes everything. You stop forcing the count, you start recognizing structural truths, you stop chasing trades, and you start managing strategic probabilities. And that's not just analysis, that's intelligent forecasting. Well, this is exactly what you'll find in the Elliott Wave Compass Report. It's our bi-weekly publication where I apply this comparative pattern logic across stock indices, currencies, commodities, and interest rates. And you'll see valid versus invalid wave count analysis, exact Fibonacci price targets for you to work with. Certainly that's important when we talk about probabilities, risk reward. And you'll get correlation comparisons so that you'll get structural confirmation of what setups are being traded. Well, it's not an almanac. It's the closest thing we have to seeing around the next market corner with structure. Trade with structure, not hope. So let me ask, if you could increase your probability of getting a forecast right, not by guessing, but by comparing patterns across markets, why wouldn't you? Well, click the link below this video. Get access to the Elliott Wave Compass Report, 8 expert reports per month, built on 40+ years of application and real-time success. So, less than the cost of a losing trade and potentially the edge you've been missing. I'm Peter Goodburn, and I look forward to showing you what the markets are really telling us, and when we finally stop chasing certainty and start mastering probability.